Hey, it's Mark Ferguson with Invest for More, standing outside my first rental property that I bought in 2010. We just sold it today to do a 1031 exchange into a $600,000 commercial property. So this is a great property, really helped me start my journey in rental properties. Bought it for $97,000. We sold it for $270,000, and $140,000 of the proceeds is going towards the new property. I had to refinance this one and taken out a bigger loan. So we'll talk about how the 1031 works. We'll show you the new property and go over the whole process on buying rentals and exchanging them without paying taxes. So this is the property I just bought after selling that other rental property, my first rental. Sold that, 1031 exchanged it into this property, which is a 10,000 square foot commercial property in Eaton, Colorado, that we bought for $592,500 basically. And after we add a new tenant, this could possibly be $1 million property with value add thanks to the amazingness of commercial real estate. You can see it is on a very busy, loud corner, which is awesome for commercial properties. So you just saw the first rental property I ever bought and how we exchanged that into the new commercial property. But how did that actually work? Right now I'm on my blog at investformore.com. You can see that right there. And I have a very in-depth article that goes over the 1031 exchange. Now I'm going to talk about it. I'm not going to just make you go there and look at it. But this helps give me some reference and to show you exactly how it is, because it can be a little tricky. Now I have started doing some really cool things on the site with memes. So we have a lot of different Instagram memes and stuff like this, and we're implementing them into our site too so people can get visual. So basically this is how the 1031 works. You sell a rental property and have a qualified intermediary hold any cash proceeds. So you can't hold this money. You can't take the money and put it in your account. Someone else has to do it, and they have to be qualified to do it. There's a lot of different people who can do it. I hired someone who specializes in 1031 exchanges. Once you sell the property, you have 45 days to identify a new property. And when you identify a new property, you have 180 days to close on that property. So once you figure out what property you want, you have a bunch of time. But I was very tight on time because I did it a little backwards. I found a property I wanted to buy, and then I figured out a property I wanted to sell, try to sell it really quick, and buy the new one. It worked out, but it was very tight on time. Now, all cash proceeds must be used on the new property. So you can't take $100,000, just pocket it, and then put $40,000 into the new property. If you're getting $150,000 back at closing, all $150,000 has to be invested in the new property. You can't take any out, or else it can become a taxable event, become very complicated. Now, you also, when you buy a new property, the new property has to be at least as expensive as the old one. So, right, I sold my first rental property for $275,000. I think I said $270 in the first video. I was wrong. I shortchanged myself. But I sold it for $275,000. So any property or properties I buy have to be at least $275,000. I can't buy one for $200,000, or else it becomes a taxable event as well. Now, you can sell multiple properties and exchange them into one, or vice versa, sell one property and exchange it into multiple properties. So I could have sold 3 and bought 1, or sold 1 and bought 3, as long as the ones I'm buying are worth more, or I'm paying more than the ones I'm selling. One of the cool things about the 1031 is you can refinance the replacement property and take cash out after buying. So for the commercial property I'm buying, I bought it for $592. It was under rented. I have extra space. I could put a tenant in there. There is a very realistic possibility the property can be worth over $1 million once I have it fully rented. I could refinance that property at $750,000 if I do a 75% loan-to-value loan. I have a private money loan of $430,000 on it. We took, I think it's $140,000 of proceeds and put that into the property. So if I refinance it for $750,000, I basically would be getting $310,000 back after taking out the refinance fees, appraisal, and all that stuff. So even though all my money has to go into buying the new property, there's no law that says I can't refinance that property and take that money back out. So that is one way to have that cash. And there's a reverse 1031 exchange as well, which is kind of my backup plan in this situation, where you you buy a property first and then sell the property you have. However, in that situation, you've got to come up with the cash. So that $140,000 that I was getting from the first rental property sale, I have to put that into the deal. Buying the first one, all cash. I can't just get a loan for it. I have to put that into the deal as cash, and then I would get paid back when the 1031 is done. Plus, it's more expensive to do that with the qualified intermediary, at least the one I use, to do the reverse exchange. So there's a lot that goes on with the 1031 exchange, as you can see. And this article goes through quite a bit of different things on how exchanges work, what we just talked about, the taxes. And this is kind of a cool thing, how much in taxes you would owe if you don't do a 1031. So this is important. I sold 2 rentals a couple years ago, and I did not do a 1031 on them just because of the time frames, what we talked about. I had sold them, but I didn't really have a property in mind to replace it with. So I just sold them, paid the taxes, took the cash. It cost me more money, but I wasn't rushed into buying a property, and I didn't really have a property to move the cash into, so it made sense for me. But it is kind of complicated how you figure out what the taxes would be owed, because you can depreciate a property over 27 and a half years for residential or 39 years for commercial. And when you sell a property, if you depreciate it for 10 years, you've got to recapture that depreciation and pay taxes on that money. You also pay taxes on any profit you have during the time you owe the property. So it can be kind of confusing figuring out what the taxes you owe are. And then the capital gains rates can vary. It's 15% for some people. If you make more money, it's 20%. And there might also be state capital gains taxes as well. So that can be confusing. But I did kind of a cool thing recently. We built a calculator that helps people determine how much they'll owe on a 1031 exchange. So that's on my site as well, the 1031 exchange savings calculator. I did a short little video on how to figure all this stuff. But what you do is you go down here, put in whatever your capital gains rate is. So for me, there we go. 20. Colorado, I'm in Colorado. I'm pretty sure there is a little bit here too, but I'm not even sure exactly what it is. We'll put that, that's right. Okay. And then we come down here. What did I buy the property for? I bought my first rental for about $97,000. I think it was like $96,900 to be exact. My sales price minus closing costs. So I want the profit. So I sold it for $275, but I had to pay some real estate agent commissions. We had a few repairs we made, so we'll just say $260. These aren't exact. These are just, basic numbers. And then my cost basis. So this is, what the property I bought it for minus the depreciation I paid over the years. So I think I've had it 9 years. I don't have the exact figure here. Wait, I can figure it out. Let's be smart about this. So actually I would value the structure of the property when depreciating it, not the land. So we'll say it was worth $85,000. You multiply we're doing this backwards. We're going to do this. 1 divided by 27.5 equals that. Multiply that times $85,000, and we can depreciate that much money a year. So multiply that by 9, and that gives us $27,000. So what did we say we have? Or 28,000. We'll round it up. If you guys are following me here at all, we're going to deduct 97,000 minus 28,000. So my cost basis is 69,000. So what I did there is I took my purchase price and deducted all the depreciation I've taken over the years, because that's tax advantage. That's money I don't pay taxes on. But if you sell, you do have to pay taxes on it. And that rate is different than the capital gains rate too, which makes it confusing. I think it's usually 25%, but it can be different rates as well. So we have this here too, just to say number of properties you're purchasing and the value. That's just to make sure that you're buying a property for as much as you're selling it for. And then you have the exchange rate fees. And then we see right here, it tells you the cost of the 1031, $1,200, the taxes without 1031 exchange. So it's basically saying we would pay $48,000 in taxes if we don't do the exchange, but there's $1,200 we wouldn't pay in fees for the exchange as well. So it saves us $46,800 in taxes to not do, or if we do the 1031 exchange, we'd be paying that much more in taxes if we don't do it. So it was a massive advantage to do the exchange in this situation because we sold it for so much more than we bought it for. Of course, talk to an accountant for the exact specifics on what this is. This is a rough estimate, not an exact science calculator, but it just gives you an idea of how much you might be paying if you do sell one of your properties. All right. So now we can go back here, take a look. Costs. Do you have to depreciate a property? Yes. You don't have the choice to not depreciate your property. You have to. So that's something to consider. You have to have like-kind properties, which basically means any real estate can be exchanged for other real estate. But these are some things that can't be used in a 1031. Stock and trade, stocks, bonds, other securities or evidences, interest in a partnership, certificates of trust. So basically, many, many things can be used in a 1031 exchange. But you cannot flip houses and do it for the most part. So again, talk to your accountant. But a lot of people say you must hold the house for at least a year, and it might have to be rented for that time to qualify for a 1031 exchange. And if you flip a lot of houses, meaning you flip, I don't know what the ruling is, the IRS is not clear, but if you're considered a house flipper and that's your job, what you do, you're considered a dealer, the IRS will look less kindly on you if you're trying to do 1031 exchanges for those properties. So be very careful doing that. We've been through how to do the 1031 exchange, but here are some people who can be that qualified intermediary: attorney, CPA, a real estate agent, relative employee. Just be careful how it's done and make sure it's done right. That's why I used a 1031 company, so it did not get messed up. You need to take title in the same name or business name for the new property as the one you sell. You cannot use the exchange to make repairs. I asked that one. And then reverse exchange, which we talked about. You buy the new property, then you sell the old property. And, of course, how to get your money back out. You can refinance it. Can you use a personal residence? This is tricky, too. You might be able to do a 1031 exchange into a rental property, keep it as a rental for a while, and then move in. Again, talk to your accountant, because I've heard varying things on this from different people. Always be careful. Talked about the 1031, why I didn't do it before, and then, of course, how I completed it on these properties. The one I sold, the one I bought, and then this is kind of a cool meme because the very first, well, not the very first house. Now my computer's not going to work. Oh, come on. Anyway, this house right here was my second personal house I bought. Got an awesome deal on it. Ended up refinancing it a year after I bought it for took out $50,000 in cash. That's what I used to buy my first rental property. And that kind of turned down into this property, which who knows at some point may become $1 million property. So I'm a big fan of buying a personal house to live in if you do it right. And that's one example of how it can be an amazing way to get your journey started. All right, so that's the article. That's everything I have to say about the 1031 exchange. For the numbers on my particular deal, like I said, sold this for $275, had about $140 to go into the new property. All of that money had to go into it. We got a private money loan to cover the rest of it, almost all the rest of it. I brought $20,000 in cash myself. And then the plan is to release this property, get it stabilized, refinance it, put a long-term loan in place, probably take some cash back out, then repeat the process. And I have a couple other rentals that I'm thinking about doing a 1031 exchange on now that are vacant. I just don't have another property to buy yet. So we'll see what happens. We might be doing this process again and again, just taking these very expensive single-family rentals because Colorado market's so crazy. selling them, taking the proceeds and putting them into much better rental properties, which are much better cash flow, much better yield, and value add possibilities. All right, so that's the video. Hope you guys enjoyed it. Please leave questions below. If you have any comments or questions, I love responding. Love seeing a thumbs up and subscribers too. So hopefully you'll see some new videos of us doing more exchanges or buying more rentals or more flips. We're doing a lot of different stuff right now. Hope you enjoy it. Hope you like the videos, and we will be back soon.